Canada posted its first goods trade surplus in 6 months on Tuesday, a $1.78 billion swing from a $5.11 billion deficit the month before. The engine behind it was the Iran war. Crude prices surged as the Strait of Hormuz remained effectively closed, lifting the value of Canada's energy exports. Gold shipments hit a record high in the metal and non-metallic category, up 24%. Suncor Energy reported first-quarter results that topped profit estimates, even as oil market turmoil weighed on the sector broadly. The TSX, however, finished the day lower, while U.S. markets pushed to new records on earnings optimism. That gap, Canada's trade account improving while its benchmark index fell, pointed to a split running through Tuesday's session, commodity producers winning, tech and consumer names losing. And no single stock illustrated that losing side more vividly than Shopify, whose shares opened at 116.05 after closing the prior session at 127.55, a gap down of nearly 9% before a single trade was placed. Shopify's first quarter, by conventional measures, was excellent. Revenue grew 34.3% year-over-year to $3.17 billion, beating analyst expectations. Earnings per share came in at 36 cents, ahead of the Zacks consensus of 32 cents. Merchants processed over $100 billion in gross merchandise volume across the quarter. That is the kind of result that normally triggers upgrades and target price raises, and several analysts did exactly that, with Needham reaffirming a buy at 180 and Royal Bank of Canada maintaining an outperform at 170. The sell-off had nothing to do with what Shopify reported, it had everything to do with what it guided. For the second quarter, Shopify projected revenue of approximately $3.42 billion. That translates to year-over-year growth of roughly 27.5%, a sharp step down from the 34% posted in Q1. Operating profit guidance also came in below expectations. The market read the deceleration as the signal. Shopify reported a net loss of $581 million for the quarter, a figure that received less attention than the growth trajectory. Shopify President Harley Finkelstein, on the analyst call, said artificial intelligence now accounts for more than half the coding done at the company, a threshold that has been rising significantly. The AI disclosure was meant as a sign of operational leverage. Investors heard it as a reason to ask how much harder it becomes to sustain 30+% revenue growth when the easy efficiency gains are already priced in. Here's the condition that changes everything. Citizens JMP had already cut their target from $200 to $160 in February. If second quarter results come in below the guided $3.42 billion, the stock re-rates lower on a growth story that has already been marked down once. If Shopify delivers at or above that number, the Q1 to Q2 deceleration narrative collapses, and the stock has significant room to recover toward the 170 to 180 analyst cluster. The Shopify episode fits a documented pattern. A company grows fast enough to attract premium multiples. Growth continues, but at a pace slightly below the implied trajectory. The stock corrects, not because the business deteriorated, but because the market priced in a perpetuation of the prior rate. The 2021 to 2022 Shopify sell-off followed this script. The company went from a pandemic-era growth darling to a multi-year restructuring story when growth normalized. Tuesday's drop is smaller in scale, but the mechanism is identical. The penalty is not for missing, it is for decelerating. The difference this time is context. In 2021, the macro backdrop was accommodating. In May 2026, the Bank of Canada is holding its key rate at 2.25%, while warning that future decisions are clouded by geopolitical uncertainty. Spirit Airlines shut down over the weekend. The carrier cited jet fuel costs driven by the Iran conflict as the proximate cause, and its closure was described by Canadian airline executives as a warning shot for every thinly capitalized carrier in North America. Consumer and travel spending is already under pressure from elevated energy prices. That environment makes it harder for any platform dependent on merchant commerce, which is what Shopify is, to sustain the growth rates that justify its current multiple. The trade surplus that Canada posted on Tuesday was built on war-driven commodity prices, not on broad economic strength. If the Iran conflict de-escalates and oil prices normalize, the surplus reverses, and the macro pressure that supported energy names disappears. Shopify, which has no commodity exposure, would not benefit from that reversal directly, but lower energy costs would ease the consumer spending pressure its merchant base faces. Evidence so far tilts to continued multiple compression on Shopify until the Q2 print, but only while the guidance deceleration narrative holds. If Q2 revenue comes in at or above $3.5 billion, above the guided figure, the bear case loses its anchor. The benchmark to watch is the Q2 earnings date, expected in late July or early August. The question that Tuesday left open is the harder one. Can a platform that has already pushed AI-driven coding past 50% find a new acceleration driver before the market decides that deceleration is permanent? Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.